Today I'm going to give our friends in the real estate profession and real estate investors in general a bit of a math lesson. And I know what you're thinking, math lesson, boring. But it turns out it's actually interesting and very, very helpful to know exactly what our real rate of return is. So the first thing I need to do is talk a little bit about something called the money-weighted rate of return. And for the geeks among you, the money-weighted rate of return is calculated exactly as you calculate the internal rate of return. The money-weighted return is useful because it looks at not only the purchase price and the sale price of an asset, but it looks at all the intermittent cash flows that you paid for or received from that asset over time. So in the case of looking at a piece of real estate, for example, we'll pay attention to things like property taxes, maintenance, any renovations you did while you owned the property. The reason we do this is because there's more to figuring out what your return is on any investment than looking at just what you paid for it and what you sold it for. It's very naive to think all that matters is what you bought it for and what you sold it for. We need to get a little bit more sophisticated in our thinking to figure out what the real rate of return on a thing is, and money-weighted rate of return is a great way to do that. So the best way to describe what I'm talking about in terms of the money-weighted rate of return is to look at an example. So imagine a family bought a house in Toronto at $300,000 11 years ago, and they sold it yesterday for $800,000. Now the real estate agent, another real estate investor, might say that's a fantastic rate of return. You made $500,000 over 11 years on a $300,000 investment. That's a 167% return. That's fantastic. The problem is that would be a naive way to look at it because over time there are other cash flows associated with that house that have to be factored into working out what the real rate of return is. Let's imagine in our hypothetical example, they needed to get rid of the shag carpeting, cement countertop, they needed to repair the roof, they spent $40,000 on renovations in the first year of owning the house. Let's also assume that they spent $4,000 a year on property taxes on the house. It costs about $500 a year to maintain the house in terms of doing minor repairs, about like pairing some silicone or caulking, a hinge needs to be replaced or whatever. It costs about $500 a year. When we take all these costs into account, we get a much different picture on the return of this real estate. Different picture, but a much more realistic one. When I said we're doing a math lesson, what I meant is we're pushing a few buttons on a calculator. It's actually not that complicated. To do the money-weighted rate of return, I am going to be using my financial calculator. I recommend everyone get one of these, not only because you get to do funky financial calculations, but also you look like a member of the CFA Institute, and what could be cooler than that? So here goes. So what we find is that the internal rate of return, or the money-weighted rate of return on this, 3.17% compounded annually. Now compare that to looking only at price to price, which had about a 9.15 rate of return compounded annually. We get a much more realistic and a much lower return. This real estate that looked fantastic, but just going price to price, isn't actually that great. At the time, I think GIC rates were somewhere between 6.5% and 7%. A guaranteed risk-free investment that doesn't demand a check every month. GICs don't need to have a roof repair. They don't need to be, repaired at all or maintained in any way, compared to a piece of risky real estate where you use huge amounts of leverage in order to hopefully gain a return. GICs, which you know when you buy them what you're going to get, crushed this piece of real estate. Over the time that I held my real estate, the shares of Royal Bank did a compounded annual return of 13%, plus the dividends that they paid out 4 times a year. Obviously you wouldn't have known that in March of 2000 when I bought my house, but the point I'm making is that there are much, much better investments out there than real estate, especially when you take into account all the negative costs associated with it. So what's the lesson here? When it comes to investing, everything is relative. Risk is relative and the returns you're going to get is relative. So if at the time that these people were thinking of putting up $300,000 of capital to buy a house, if at that same time they were like in my situation, they could have gotten somewhere between a 6.5% 7% interest rate on GICs, you need to arm yourself with all the tools necessary to work out what the real rate of return is on real estate. Factor in those costs like property taxes, renovations, and ongoing maintenance, because that money is just as real as the money you use to purchase the thing and the money you receive when you sell the thing. So in this relative investment environment, I hope we now understand a little bit, real estate investors and real estate professionals, that the math is a little bit more complicated than just looking at purchase price and sales price. Thank you very much as usual for watching. If you know anyone who might be able to benefit from this video or others I do, Please share the wealth, and as usual, please subscribe. Thank you very much. See you next time.